If you own an HVAC, roofing, or trades business, you might be paying $20,000 more in taxes every single year because of how your business is structured. And the hard part is your CPA may know exactly why, but they may not have started that conversation with you. Most CPAs are focused on filing your return, but filing your return is not the same thing as protecting your money. I'm Mia Reeves. I'm a certified public accountant, and I work with trades and home service business owners. Today, I want to walk you through 6 conversations I have with my clients every single week. This is general education, not personalized tax advice, because every business is different. But if your CPA has not brought these up with you, you need to ask why. Let's start with the one that may be costing you the most right now. The first thing I want you to understand is this. Your LLC is not a tax strategy. A lot of business owners set up an LLC and think their taxes are handled. They check the box, they got the paperwork done, and they move on. But an LLC is a legal designation. It is not automatically a tax plan. I had a client come to me who was doing really well with over $1 million in revenue. He had his LLC set up, and from the outside, everything looked fine. But when I pulled his returns, he was still filing as a sole proprietor. That meant every single dollar of profit was getting hit with self-employment tax. We were talking about over $20,000 a year just gone. When I showed him the numbers, he said, "Don't be too surprised that I don't know any of these. No one has ever explained anything to me about any of this." And that is the issue. He was not doing anything wrong. He was out there running crews, climbing ladders, dealing with customers, and keeping the business moving. But no one had sat him down and explained what actually happened with his money. By default, a single member LLC is taxed as a sole proprietor. That means every dollar of profit is subject to self-employment tax, which is 15.3% on top of regular income taxes. The fix may be an S-corp election when it makes sense for your numbers. That does not change your legal structure. It changes how your income is classified for tax purposes. Instead of all your profit being subjected to self-employment tax, you pay yourself a salary, and the remaining profits may come out as distribution. And that distribution is not hit with that 15.3% self-employment tax. For a roofing business netting around $300,000 a year, that difference can often be $15,000 to $25,000 in tax savings every year. And that is the kind of basic election that your CPA should be discussing with you when your business crosses around $80,000 or more net profits. According to the IRS data book, sole proprietors are audited at around roughly 10 to 15 times the rate of S-corps. So your business structure matters for taxes, for audit risk, and for how much money you keep. But getting the S-corp election right is only half of it, because what you do next is where a lot of business owners give the savings right back. Moving to the second issue, let's talk about how you pay yourself. If you're a trade business owner and you're paying yourself the wrong way, it can cost you $20,000 a year or more. I had a client whose S-corp was set up correctly on paper. So I asked him, "How much have you paid yourself this year in salary?" He said $10,000. At that point, the business had already netted almost $200,000 a year. And then I asked, "How are you paying yourself?" He said, "I just run off-cycle payrolls when I remember to." And I understand how that happens. You're busy, you're managing crews, handling customers, solving problems, and trying to keep your jobs moving. Payroll for yourself can feel like the last thing on your list. But the IRS does not care that you're busy. Once you have the S-corp, the IRS requires you to pay yourself what they call the reasonable salary. They do not give you one exact number. They use a word, reasonable, but you can use certain compensation tools, industry data, talk to your accountant, and you can figure out your responsibility to support the number you choose. For an owner operator of an HVAC company doing around $1.5 million in revenue, that salary might commonly fall between $70,000 and $100,000. Could be more than that. But the profit above that can usually come out as a distribution. So let's walk through the math. Say your business net $250,000. You pay yourself $90,000 in salary. The payroll tax on that is roughly $13,700. The remaining $160,000 comes out as distribution with 0 self-employment taxes. Now compare that to a sole proprietor where the full $250,000 gets hit with self-employment tax. That number is $38,250. So the difference is over $24,000 in savings every single year. But here is another side to this. If your salary is too low compared with what your business makes and what you actually do in the company, the IRS can question it. They can cross-reference your numbers. And if the numbers look off, they may come looking. So the action here is simple. Do not guess at your salary. Sit down with your accountant, for your CPA and look at your profit, look at your role in the business, and document how you landed the number. Now that we have talked about your structure and your pay, let's talk about something you can actually see. Your trucks, your tools, your trailers, and your equipment. A lot of people do not realize the IRS actually allows you to write off qualifying equipment. And even when they do know that, the deduction is not always being handled correctly. I had a client who bought a work vehicle, financed it, and used it almost 100% for business, but nobody has set up the depreciation correctly for him in the past. He was slowly writing it off over several years when he may have been able to take the full deduction in year one. And it was not just the vehicle. There were trailers, tools, and other equipment sitting there from a tax perspective doing almost nothing for him. Section 179 allows you to deduct the full purchase price of qualifying equipment in the year you buy it instead of spreading it out over 5 to 7 years. And with the one big beautiful bill that passed last year, 100% bonus depreciation is back for property placed in service after January 20, 2025. And that means certain equipment can potentially be written off fully in year one again. But timing matters more than many business owners realize. Buying equipment in December versus waiting until January can be the difference between taking a major deduction this year and waiting 12 full months for it. And that is not a conversation you want to have in April. By then, the year is already over. And this is a conversation your CPA should be having with you in October when there's still time to make a decision. So make a list of every major vehicle, trailer, tool, and equipment you bought or financed this year. And then ask your CPA how each item is being depreciated and whether Section 179 or bonus depreciation applies. Before we move away from the numbers, we need to talk about your books, because messy books are costing you more than you know. The first thing I look at with the new client is their books. And 9 times out of 10, I can already see where the money has gone missing. I onboarded a home service company that was close to $2 million in revenue per year. And when we got into the books, it was rough. Deposits were not matched to invoices. Transactions had been sitting in Ask My Accountant for months. Personal expenses were mixed with business expenses, and there was no clear profit and loss statement. His previous accountant had actually sent him a certified letter saying that they were done working together, and that is how messy things had gotten. He had been making hiring decisions, equipment decisions, and tax decisions based on numbers that were not accurate. I showed him the profit and loss statement, and he said, cannot be right. He was correct. It was not right because nobody had reconciled anything. When your books are messy, 2 things happen. First, you miss deductions because nobody can find them. And second, if the IRS ever looks at your return, disorganized financials create risk. According to the IRS audit data, one of the biggest triggers for small business audits is not always fraud. It is the inconsistency. Personal expenses mixed with business, missing records, numbers that do not add up. The S-corps may be audited at the lower rates than sole proprietors, but clean books are still what allow your tax advisor to do proactive work for you. If every conversation is about cleaning up last quarter's financials instead of planning for the next quarters, you're always behind. And when you're always behind, you're usually losing money you did not have to lose. The action step here is to clean up your books before year end, reconcile your bank accounts, clear out Ask My Accountant, and separate personal and business spending. Make sure every loan, credit card, payroll account, and major equipment purchase is properly recorded. The 5th issue is one that many trades owners ignore until it's too late. Your exit will be very expensive if you do not plan it. The biggest money trade owners lose is not always while they're running the business. Sometimes it is the day they sell it. A client of mine has multiple companies, strong revenue, and real growth. He wants to sell it in about 3 years, but when we sat down and looked at the financials, he only had cash basis accounting. He did not have clean accrual financials. And without clean accrual books, for at least 2 to 3 years before a sale, buyers can either walk away or seriously discount what they're willing to pay. We caught it in time. We're cleaning things up now, so when he's ready, everything is in order. But if he had waited until 6 months before the sale, there would only be so much we could fix at that point. Under Section 1202 of the tax code, qualified small business stock may allow certain C-corp owners to exclude up to $10 million in capital gains on a sale if the business meets specific requirements. That could potentially mean a major portion of the sale is tax-free, but that requires planning years in advance. You cannot figure that out the week you list your business. The difference between a planned exit and an unplanned exit can easily be $200,000 to $500,000. That is money that could go to the IRS instead of your family because no one had the conversation early enough. So stop thinking about an exit as something you only plan when you're ready to sell. If you may sell in the next 3 to 5 years, talk to your CPA now about your entity structure, your books, your accounting method, and what a buyer would actually need to see. All 5 of the things we just walked through only happen when someone is paying attention to your business throughout the year. That brings me to the 6th issue. If your CPA only talks to you at tax time, you probably do not have a tax strategist. You have a tax preparer. And those two are very different things. Filing a return is looking backward. It documents what already happened. Tax strategies is looking forward. It means you are making decisions now that can change what your return looks like 12 months from now. A tax strategist meets you in October and asks about your projected income. Should we time an equipment purchase before December? Should we look at the retirement contributions? Does your salary to distribution ratio make sense? Are your books clean enough to make real decisions? You are running numbers together. You're looking at projections. You're planning before the year is over. A tax preparer calls you in April and tells you what you owe. I had a client whose wife was on the call when we walked through the numbers. His first reaction was, so every dollar I earn, 37 cents go to the government? And she looked at me and said, let's fix that. And we did. We sat down, looked at the numbers, and built a plan together. S-corp election, salary structure, retirement strategy, timing on equipment purchases. None of that is complicated when you have the right process, but it does require someone to pay attention throughout the year. Every point in this video, the S-corp, the salary, the depreciation, the books, and the exit planning, none of it happens automatically. It happens because someone is asking the right question before decisions are made, not after. So here's the plan I recommend. First, confirm how your business is currently taxed. Do not assume that having an LLC means you have a tax strategy. Second, look at how you're paying yourself and whether that salary is reasonable for your role and your profit level. And third, list every major vehicle, tool, trailer, and equipment purchase from the year and ask how is it being deducted. And fourth, clean up your books so your profit and loss statement actually tells the truth. Fifth, if selling your business is even a possibility in the next few years, start with exit planning conversation now. And 6, ask yourself whether your CPA is helping you plan during the year or simply filing your return after the year is over. If your business is doing over $1 million in revenue and nobody is having these conversations with you, I believe you deserve better than that. This is general education and not individual tax, legal, or financial advice. Your facts matter, your state rules matter, and tax laws can change over time. Before you make decisions about entity structure, payroll, depreciation, or exit planning, talk with your own CPA or attorney and build a plan that fits your business. And if you want to go deeper on the LLC and entity structure piece, I made a whole video breaking that down. Go watch it next. I'll see you in the next one.